So, when we're talking about the biggest banks, they have an issue. Under 3% of credit cards are now behind. At the small community banks, it's over 6%. That gap didn't exist before 2008. It actually got built that way. And when the big banks push their riskiest customers down the ladder to the smaller banks, well, you're going to find out what happens. Here's the full story and how it hits you, even if your credit card is paid off.
There is a bank on a courthouse square somewhere near you that has been open since before the Depression. Doors at 9, same as they always were. Nothing in that lobby tells you anything is wrong. Its credit card book is running at 6.43% behind on payments. At the 100 largest banks in this country, that same number is about 2.8. And the worst it ever got for banks like this one, at the absolute bottom of the 2008 crisis, was 5.9. Last week, we showed you the borrower, groceries going on a credit card. Tonight is the other side of that ledger. Who is holding it, and what happens to your town when they stop? Let me tell you what that number actually counts, because it matters. Every bank in America files a report with regulators 4 times a year, and one line in it says how much of the credit card money they lent out is at least 30 days behind. The Federal Reserve publishes it 2 ways. The 100 biggest banks in one column, everybody else in the other. The 100 biggest sit at about 2.8%. Everybody else sits at 6.43. The figure you see in the news is those two blended together, which comes out around 2.9, and that number is fine, and it is also a description of nowhere. Now here's the part I want to say before somebody else says it for me. That 6.43 is going down. A year ago, these banks were at 7.17. At the end of last year, they were at 6.62. 4 quarters in a row of improvement. And a Federal Reserve branch published a note this year saying subprime card delinquency has fallen, which is accurate. So if you came here for a number that is spiking, it is not spiking. Stay with me anyway, because the direction is not the story. What is moving it is the story. A loan stops being counted as late in exactly 2 ways. The first one is the good one. The borrower catches up. The account goes current. The second one is different. When a credit card goes about 180 days without a payment, the bank gives up on it. They write it off, take the loss on their own books, and either hand the debt to a collector or sell it. And the moment they do that, the balance leaves the late column too. Not because anybody caught up, because the bank stopped counting. Both of those show up in the data the exact same way. The line goes down. So when you read that delinquency is improving, that sentence is doing something quietly dishonest. It describes an accounting outcome and lets you hear a human one. Here is my read, and this is me arguing now, not the Federal Reserve. At the banks that lend to working people, I think most of that improvement is the second kind. I do not think those accounts are being cured. I think they are being cleared out. You can disagree with me on that part, but look at what the write-offs are doing while the late number falls, and then tell me people are catching up. One more thing about timing. Write-offs run about 3 to 4 quarters behind delinquency. So the losses landing on these banks right now belong to trouble that started a year ago. Whatever is happening this quarter has not surfaced yet. Now let me take you back, because the year everybody gets wrong here is 2008. The gap between the big banks and the small ones did not open at the crisis. Go and look. It opened around 2017. Card delinquency at the smaller banks ran near 3%, then it climbed past 5%, and by late 2018, it reached 6.2. That 5.9 figure I gave you, the crisis peak, they went straight through it, and they have never come back under it since. Read that again, because it is the whole video. These banks have been worse off than they were at their own 2008 crisis high for about 8 years running. Through record employment, through a boom, through a stretch when everybody agreed the American consumer was strong. Nothing dramatic happened in 2017. There was no recession, no shock, no headline, which is exactly why nobody told you. So what did happen? Here's my explanation, and I want to be straight that it is an explanation and not a measurement. After 2008, The biggest card issuers tightened up hard. They stopped approving the borrowers who had burned them and built themselves prime-only books, and that part is well documented.
Hey everyone, real quick, if you are in debt and you want to get out of debt forever, I put together something called the Dominate Debt course. Links down below. It will change the game for you if you want to finally end that bondage of debt. And it's a good thing to get out of it. Links down below. Take a look at it. Let's get back to the video.
But the people they stopped approving did not stop needing a credit card. They went looking down market. And smaller banks, which need yield the way every bank needs yield, took the pool the giants let go of. That is the two-tier system. One set of banks got the safe customers. Another set got everybody else, along with the interest rate that comes with everybody else. 18 years later, you can read it in 2 columns of the same government spreadsheet. The average American hears 2.9% and concludes the country is fine. Now you know what is inside it. And it matters enormously who those other banks are. Community banks hold most of the deposits in rural America. They write roughly 3/4 of the country's farm loans. And they are about 3 times likelier than a big bank to be the only bank office in an entire county. I am talking about geography there, not about any individual. Because geography is what this data can honestly tell you. Look at what that means, though. The card books running hottest sit at the banks a lot of places have no alternative to. If your city has 40 branches, one lender pulling back is an inconvenience. If your county has one office, that lender is the entire credit market. And somewhere in one of those towns tonight, somebody is deciding which bills get paid in what order. The card that buys groceries gets paid first. It always does. Which tells you something uncomfortable, because if the grocery card is the one slipping, everything above it in that order already slipped. Here is what a bank does when its card book stops working and almost none of it gets announced. Reserves go up because regulators require money set aside against expected losses. Lending goes down because that money is now sitting still. Credit limits get trimmed. Annual fees appear on cards that never had one. Portfolio review letters go out. Some banks leave the card business altogether and hand it to an outside program. And one platform moved billions of dollars of card loans off its own books. 2 small banks failed in the first half of this year. Cards were not named as the reason for either one, and I am not going to pretend otherwise. I mention it for the environment, not as a cause. There is also a parallel line worth knowing about. Trade coverage of the 5th subprime auto index put 60-day delinquency at 6.9% in January, described as the worst since that index started in 1994. The original sits behind a paywall, so you are getting that one secondhand from me. Same borrower, different product, breaking at the same time. And when a repossessed car recovers about 1/3 of its value instead of the 40+% it used to, the lender stops waiting sooner. So read the mail before you read the news. Find out which tier holds your card because it is printed on your statement and it decides how that lender behaves when things tighten. If you carry a balance, the number that decides your life is not 6.43. It is your interest rate, which is running over 22% for anyone actually carrying a balance month to month. That is the emergency. The delinquency series is a thermometer. The rate is the fire. Then watch your mail for 3 things: a limit reduction, a new annual fee on a card that never had one, and anything using the phrase portfolio review. Those arrive 1 or 2 quarters before any of this reaches a news story, and they arrive quietly, addressed to you personally. And know when the honest checkpoints are. The next print of these 2 series lands around the 19th of August. If the late number keeps falling while the write-offs stay heavy, that is not people recovering. That is confirmation. Back to that bank on the courthouse square. Doors at 9 tomorrow, same as 1932. The lobby will look exactly the way it looked today. Its card book has been sicker than it was in 2009 for 8 straight years, and nobody put that on television because the line was pointed in a comforting direction the entire time. 3 weeks from now, it gets remeasured. If 6.43 becomes 6.1, half the internet will call it good news, and nobody will check whether those accounts got fixed or got thrown away. So tell me this, has anything about your own credit quietly changed this year that you never asked for? Credit doesn't crack where the money is, it cracks where it isn't. Economic Ninja is out.